If you want a simple, long-term ETF portfolio that gives you global diversification but doesn't overcomplicate things, this video is for you. Today, I'm going to cover my 5 favorite ETFs, and for 99% of investors, you really don't need more than this. And this is not to brag at all, but simple ETF investing with the funds that we are going to cover today has helped me reach over 6 figures invested in my 20s. And so it just goes to show that your investing strategy doesn't have to be complicated. As long as you're consistent, you can be a successful investor. All that said, let's go ahead and get into my 5 favorite ETFs along with one honorable mention that I'm going to cover at the end. Let's go ahead and jump into my phone. Now that you can see my screen, we're going to be using the public app to actually go through and look at all these 5 ETFs. The first ETF, which as you can see is Vanguard's S&P 500 ETF VOOO. No matter what portfolio you have, I think that having a fund like VOO or an S&P 500 fund is a great base. As you can see, Vanguard is a very well-known provider. The assets under management for VOO is $858 billion, which is crazy. And my favorite part about VOO is the expense ratio, which is 0.03%. So that means on every $10,000 you have invested in VOO, you're going to pay $3 a year in fees, which is extremely low and awesome compared to most ETFs. Scrolling down and taking a look at the top holdings, we see the top holdings are Nvidia, Apple, Microsoft, Amazon, Alphabet, Broadcom, Alphabet, Meta, Tesla, and Berkshire. So just by looking at that, you can tell that by buying one ETF, basically basket of stocks, remember that you are investing in the greatest companies in America. And the awesome thing about the S&P 500 is that winners are going to automatically get added and losers are going to automatically get kicked out to the curb. And scrolling down from there, we are going to look at the average annual return. And over the last 10 years, VOO has averaged 15%, which is probably a little bit high than I think we'll see over the long-term average. And compared to the long-term average, it is a little bit high. But nonetheless, S&P 500, you can't go wrong with it. VOO is my pick for an S&P 500 fund, and it's one that I'm going to hold forever. Next, we are going to scroll up to the top and take a look at my next pick, which is going to be on the growth side of things. There's actually 2 here that I want to mention. The first is QQQ, which is a NASDAQ 100 ETF, which means it is heavy into the technology sector at the moment. If we scroll down and look at QQQ, assets under management, $407 billion, extremely popular. Expense ratio of 0.2%. So this is a little bit higher compared to VOO. The reason I invest in QQQ versus QQQM, which is the identical, brother to QQQ, is that QQQ has a higher volume on the options chain. So in the future, I might want to sell options against my QQQ shares, and so therefore I invest in QQQ. If you don't have any plans to sell options, I would recommend investing in QQQM. It's the exact same thing as QQQ, but the expense ratio is 0.15%, and so you'll save a little bit of money on that average annual fee. Scrolling down for QQQ and looking at the top holdings, this is very similar to VOO, but as you can see that the allocation is a little bit higher. So when you invest into QQQ, you are just essentially putting more money into the technology side of things. And over the last few years, technology has been great. And so going down and taking a look at the 10-year average annual return, you can see that is 19.5%, which is bonkers for just a passive ETF. But this is now my largest position in my traditional brokerage because of that growth. If you don't want to do QQQ, but you want to do another lower cost growth ETF, my recommendation would be VUG, which is the Vanguard Growth ETF. I actually hold this in my Roth IRA, but as you can see, similar holdings here as well too, and just like any other ETF, the new winners will be added to this and the old losers will be taken out. Average annual return on this one, 17.5%, so a little bit lower, but still nonetheless, that is crushing it over the last 10 years. And the expense ratio is 0.04%, so significantly cheaper than QQQ. So those are 2 ETFs on the growth side of things that I would recommend checking out. I hold both of those, and I plan to hold both of those for a long time. Leaving the growth side of things and going to a little bit more conservative, we are going to take a look at more dividend/value investing, and that is going to be my pick, SCHD. SCHD is the Schwab US Dividend Equity ETF. This fund over the last 5 years has not done as great as the S&P 500 or that growth fund. As you can see, up 33%. Assets under management, $76 billion. The dividend yield, though, on SCHG is 3.6%, so keep that in mind. And with an expense ratio of 0.06%. So once again, very cheap, low expense fund, which is always what we like to see. Continuing down and taking a look at the top holdings, you'll see that these are significantly different than what we saw in VOO and the other growth funds. Lockheed, Chevron, Bristol Myers, Texas Instruments, Merck, Home Depot, ConocoPhillips, Coca-Cola. Some very classic value stocks in SCHD, which is why it has not performed as well as VOO or the other growth ETFs that we looked at before this. That said, things could change, and so as an ETF investor, I like having exposure to, growth, value, the S&P 500 as well, and so that is why SCHD is my pick for the value side of things. Just gives you a little diversification outside of the traditional tech that most other growth ETFs are so heavily invested into. And then you also get that 3.6% dividend yield. So if you're looking for something that is a little bit more consistent, not as volatile as the other growth funds, and something that pays you a little bit of money to own it, SCHD is a great fund, and honestly, I think the performance will pick back up here in the next year or two whenever things shift from growth back into value, the market cycles, and so it's just not the time for SCHD right now, but I don't think it is dead forever. Next, we're going to talk about a fund that will actually give you international exposure outside of the US, and that fund is going to be VXUS. This is Vanguard's Total International Stock ETF, and honestly, it's kind of one that brings up a lot of questions with ETF investors, because I also see the argument nowadays to where you don't actually need a specific ETF for international exposure, because thanks to the internet, companies now are global, right? Starbucks, if you buy Starbucks is also in Germany. If you go buy Exxon shares, Exxon is a global company. So naturally, by buying, let's say, the S&P 500, those companies are huge and have exposure to all the global markets kind of inherently. And so some argue that you don't actually need a specific international ETF like VXUS. But if you want that specific international exposure, VXUS is one to take a look at. As you can see, it has $127 billion in assets under management, a dividend rate of 3%, which is respectable, and then once again, a low expense ratio of 0.05%. Taking a look at its holdings, you can see here that it has some names that are just not common in the other ETFs that we looked at. And so you're going to get some diversification into different companies with this, but the negative is that over the last 10 years, it's only returned around 8.5%. So you can see how that is significantly less than all the other funds that we looked at, even SCHG, the dividend fund. It's kind of a trade-off that you might make with internationals that, historically the returns have not been as good. In 2025, international actually outperformed the S&P 500, but that is usually not the case. So just keep that in mind. If you want to invest international, VXUS is one to check out to give you exposure to some of the other markets: Japan, Britain, Europe, Asia, South Korea, I believe, is also on here as well too. But that said, I would recommend, if you do use VXUS, probably keep it as a smaller position. I don't think it's worth holding as a main one, but nonetheless, it's one that I do hold in my Roth IRA, a small amount, just to give me some of that extra international exposure. And last but not least, before we get to the honorable mention pick, is the ETF that I have chosen for real estate exposure, which is VNQ, which is Vanguard's real estate ETF. So as you can see here, VNQ tracks a market-weighted index of companies involved in the ownership and operation of real estate in the United States. Once again, I don't have a huge position in this ETF, but it is a fund that gives you different exposure from the ones that we previously mentioned. So if this is something that you're interested in, this would be my pick for a real estate ETF. Dividend rate, 3.8%, which is the highest that we've looked at so far. And then an expense ratio of 0.13%, which is getting a little bit high, but it's still not anything too crazy. Top holdings that you see here are a bunch of REITs, so you can read through those instead of trying to pick one of these, and betting on it. I prefer just buying something like VNQ that gives you the overall exposure to all of them, so you're not betting on a single company. Historical performance, though, as you can see, over the last 10 years is only 5% annual. This is definitely one, if you're looking for growth, I would not recommend, but if it's one that you're looking for some cash flow, maybe for just to stay consistent, not a lot of volatility, and you want some real estate exposure, VNQ is one to check out. Now that all the normal ETFs are done with, let's go ahead and get into one that is an honorable mention, and that is going to be, drum roll, IBIT, which is the iShares Bitcoin Trust ETF. Now, I am not a huge crypto guy, but in my opinion, it is more risky to not have exposure to Bitcoin than it is to actually have a little bit of exposure to Bitcoin. So I don't have a ton of money in Bitcoin. I actually buy it through Coinbase though, so I can have the keys to my crypto. But if you don't want to go through all that mess, I would recommend, if you're young, just buying a Bitcoin ETF. IBIT is one here, has almost $70 billion in assets under management, expense ratio of 0.25%, which is a little bit high, but that's crypto for you. And then taking a look at the returns, this one hasn't been around very long, but since January of 2024, 37%. And as you can see, Bitcoin price over the last few years has gone crazy. And so this is going to closely follow what Bitcoin does. That is the unmentionable pick. Risk is involved with this one. But if you're looking for something to diversify outside of the S&P 500 growth and the value stocks, Bitcoin could be one to take a look at. So thank you for watching. I hope you found that helpful. That is my 5 favorite ETFs that I buy regularly across my Roth IRA and my traditional brokerage account. And like I mentioned, those ETFs that I talked about right there have helped me reach a 6-figure portfolio in my mid-20s. So hopefully if they work for me, they can also work for you. If you want to check out more about how I hit that investing milestone, I did a full video on it. I'll link it up here that you can check out. But thank you guys for watching. I hope you found this video helpful. Drop down below in the comments what your favorite ETFs are. There's a ton of them out there, so I'm always curious to learn about new ones. Thank you for watching though. I'll see you in the next video.